Thank you, Stephen, and good afternoon. And yes, indeed, there's some good news for South African consumers as annual inflation has retreated to its lowest level in 20 months, cooling to 5.4% in June from 6.3% in May. The latest print is also below the upper limit of the South African Reserve Bank's MPC target range. The latest drop is the largest decline since May last year. According to data from Stats SA, 6 of the 12 main categories saw a drop. 1 remained unchanged, while 5 recorded increases. Inflation for food and non-alcoholic beverages slowed for the third successive month, cooling to 11% from a high of 14% in March. Transport inflation tumbled, dragged lower mainly by softer fuel prices. The fuel index also declined by 8.3% in June. For more on this, we're joined by the chief economist at Stanlib, Kevin Lings. Kevin, thank you very much for your time this afternoon. I want to start here to find out just how close was this particular data print for you to your own forecasts and expectations on inflation, because the market forecasted anything between 5.7% and 5.6%.
Hi, good afternoon. It was a little bit lower. I think most people had, as you say, in that range, just over 5.5%. So I thought this was a good outcome, both in terms of the headline number and in terms of the core number, the underlying rate of inflation. Also, I think importantly, below expectations. It wasn't wildly below. It wasn't a spectacularly good number, but importantly, it signals that inflation is now finally back inside the target. And also, if I look at our forecast going forward, we expect inflation to remain inside the target for the remainder of this year. So I think this was a very welcome number. It should please the Reserve Bank. I hope it pleases them enough to avoid another interest rate hike. It's obviously that inflation is not yet at the midpoint of the target, which is ultimately what the Reserve Bank wants, the 4.5%. But it's moving clearly in the right direction, and hopefully they feel they've done enough work to get it there over time.
I want to talk more about the interest rate decision that's coming out from the MPC tomorrow. But let's talk about the 6 categories that dropped and what it means for consumers. Does it mean anything at all when it comes to the rest of the inflation print going forward?
Well, there were obviously some areas where there was a sharp decline. You mentioned the petrol price. That came off quite substantially. And if we look at petrol inflation, both in the month and over the past year, it's come down substantially, and that's obviously very welcome relief. It's not reflected in obviously all of the categories. Yes, food inflation is moderating, but at 11.1%, we would have to say that food inflation is still extremely high, and certainly higher than most people's salary increase. So one of the ways to look at this is, are we in a position where we've got at least positive real income growth? And the way to look at that is to say, well, have salaries gone up by more than inflation? And with an inflation rate of 5.4%, there are a lot of people who haven't been getting that sort of increase. So I think there's certain areas that are helpful for consumers, but in total, it's still got to come down a bit more in order for the consumer base to get a little bit more comfortable with where inflation is overall.
You've spoken about fuel right now, and there's something that is interesting, that it fell by 3.1% month on month following the near R1 per litre price cut that we saw last month. But when you look at food prices as well, there's been a non-alcoholic beverages inflation that was 11% year on year, down from 11.8% previously. But now with the geopolitical tensions still high, with Russia withdrawing from the Black Sea grain deal, how high is the possibility that we could see all these gains reversed because of what a lack of grain export could do to food prices, particularly on the African continent?
So that remains a significant risk. And recently there was a a major dam in the Ukraine where the wall was damaged and there's extensive flooding, and that definitely has hurt the potential for food production out of that region of the Ukraine. And we did see at the time the wheat price respond to that. So that remains a significant risk. I would add on top of it, unfortunately, the climate issue is a bit of a risk. If you look at what's going on in Europe at the moment in terms of extreme heat, there's certainly an El Nino effect that is evident in the data. This is not all climate change related, but a fairly strong El Nino effect. And there is a worry that that could show up in South Africa, for example, in bad rainfall early next year. And we've had some decent agricultural seasons in the last 2 or 3 seasons. And right now we've got more of a concern that we could go into a little bit of a drought situation next year, which would disrupt agricultural production and potentially push prices higher. So you can't get entirely comfortable with where agricultural inflation is. It's moving lower. It does look as if some of the pressure on the food producers is coming out of the system. I expect that food retailers will pass on some of that pressure. But there's always this perpetual risk, and I think the risk will remain very evident around the climate issue, that at some point we could experience a resurgence in food inflation once again.
Kevin, how much of a bearing should this latest inflation print have on the decision of the Monetary Policy Committee tomorrow? They've been meeting since yesterday, and sometimes they usually say that inflation is not everything or a majority of what they are looking at. But how much do you expect it to have a bearing and on what the outcome is? And if you can put your head on the block, what do you expect tomorrow?
So it should have a meaningful impact. The Reserve Bank has indicated that they're data dependent. In other words, what they're saying is they haven't made up their mind as to what they're going to do with interest rates. They will be guided by whatever data comes out, particularly the most important data. In this instance, that's inflation. And we've had the inflation outcome, so it should be a significant factor they take on board. If you look at where the numbers came out, they're definitely surprised on the downside, and more than that, they're now nicely inside the target. So in terms of just that inflation data alone, that's fairly compelling that you've done enough in terms of interest rates, and perhaps you could avoid a further rate hike. I would add on top of that that the rand is actually, compared with the previous meeting, the rand has net strengthened. Obviously, the rand's still volatile, so that remains a risk, but I don't think there's a significant amount of rand pressure that the Reserve Bank necessarily is concerned about. When I look internationally, there's definitely been an easing of inflationary pressures internationally. So all of that would help to put off a further rate hike. The Reserve Bank has to balance that against the fact that we've still got the 18% increase in electricity prices, which is not yet in the inflation data. That we'll know next month. And obviously this constant risk that wage pressure could be elevated a lot more in the remainder of this year, particularly in the third quarter of the year. And so I think it's going to be a close call. I'm hoping that they leave rates unchanged, that they decide they've done enough, that they signal that as long as inflation continues to move lower, then perhaps they can keep rates on hold. But if inflation doesn't behave, they would have to resume the rate hiking cycle. I do think it's going to be a close call. I don't think it would necessarily be a unanimous decision. And I can see that it would be a tough sort of debate that they would need to have. But from my perspective, I think they've put through enough rate hikes already.
You've already mentioned earlier that you expect for the remainder of the year the inflation print to be within the Reserve Bank's target range. But let's talk about the outlook once again, because South Africa has experienced a widening current account deficit amid tighter global financial conditions. This suggests that the outlook still has the possibility of an end to the MPC's tightening cycle, at least from a layman's perspective.
Sure. So, the Reserve Bank, as long as they're comfortable that over the forecast horizon, inflation will move lower. And by lower, I mean back to the midpoint of the inflation target. They certainly don't have to get inflation down to 3% to be happy. the midpoint would be sufficient, and that should allow them then at that point to consider cutting interest rates. So for them, I guess the question is, do they believe their own forecasts? If I look at their most recent forecast, it does suggest they think inflation will be behaved over the next 18 months. So they need to look at that and view the risks and decide whether or not those risks are meaningful, have those risks deteriorated. I would say on balance, since the last time they met, the risks are slightly better. And so I think they wouldn't be criticized for keeping rates on hold. Also, I think we've got to make mention of the fact that if, let's say, they keep rates on hold and let's say that inflation doesn't continue to move lower, they've always got the option of resuming rate hikes. And given how weak the economy is, I was looking at the retail sales data that came out this morning for May. Geez, those numbers are not looking good. Retail shopping activity is under significant pressure now. There's more clear evidence of a weakening of the South African economy. And I think interest rates are doing quite a lot of damage. So I personally feel they've done enough. They can adopt a wait-and-see approach, and I believe inflation will move lower over the coming months.
And of course, the retail sales for May recording a 6th consecutive real inflation-adjusted year-on-year decline to the tune of minus 1.4%, following that April decline of minus 1.8%. Kevin Lings is the chief economist at Stanlib, and thank you very much for your time. And I am hoping, just like you, that interest rates remain unchanged and we don't see that 25 basis point hike that everybody is forecasting at the present moment.